In 1996, the World Bank was still praising the East Asian economic miracle in its report, where everything seemed so indestructible. But who could have imagined that just 1 year later, decades of accumulated wealth would vanish and countless lives would be irrevocably altered? This was not a natural disaster, nor a war, but a perfect financial storm that would be recorded in history. At the heart of this storm lay an economic ironclad law that many countries are still struggling to balance today. Today, we'll return to 1997, starting with the collapse of the Thai baht, to provide a complete recap of this financial tsunami that swept across Asia. And we'll discuss what this crisis from over 2 decades ago has left for our world today. Section 1. The calm before the storm. The setup. To understand this storm, we must first go back to the golden decade before it occurred. From the late 1980s to the mid-1990s, the Asian economy was experiencing an unprecedented miracle. While people were still talking about the achievements of the 4 Asian tigers, the 4 Asian tigers, represented by Thailand, Malaysia, Indonesia, and the Philippines, had quietly risen. These emerging economies maintained high growth rates of around 6% to 9% for many years, and in some years even exceeded this figure. Foreign capital poured in like a tidal wave. Skyscrapers rose in Bangkok and Kuala Lumpur, and the stock and real estate markets boomed. At the time, everyone believed that the good times would last forever. To attract and retain this valuable international capital, governments like Thailand made a seemingly foolproof promise at the time to implement a fixed exchange rate system pegged to the US dollar. This reassured global investors, invest here and you'll not only enjoy higher interest returns, but you also don't need to worry about exchange rate fluctuations because our country's currency is forever firmly linked to the powerful US dollar. This is like a ship that, for stability, has fastened itself to a large, heavy anchor. In the short term, the seas are indeed calm, but they have overlooked a fundamental economic contradiction, an ironclad rule as immovable as a physical law, the impossible trinity. This theoretical framework was laid down by economists such as Robert Mundell, and later explicitly proposed and widely disseminated by scholars such as Paul Krugman when analyzing the Asian financial crisis. It points out that a country cannot simultaneously possess free capital flow, fixed exchange rate, and independent monetary policy. You can only choose 2 at most. At the time, Thailand chose free capital flows to attract foreign investment and a fixed exchange rate to stabilize confidence, meaning it had to abandon an independent monetary policy. This was precisely the first dark cloud gathering in the sky before the storm, a seemingly perfect but actually extremely fragile structural weakness. Section 2. The confrontation. Just as Asia was immersed in a dream of miracles, the external environment quietly changed. In the mid-1990s, the US economy recovered. The Federal Reserve began raising interest rates. A strong dollar cycle began, and the global capital started flowing back to the United States from emerging markets. This put pressure on Asian economies that relied on foreign investment and made the contradiction of the impossible trinity increasingly acute. Just then, some extremely astute financial snipers entered the scene, the most famous of whom was George Soros and his quantum fund. The core of Soros's investment philosophy is the theory of reflexivity, which posits that market perceptions influence reality, creating a self-reinforcing cycle. He observed that Asia's prosperity was built on a fragile exchange rate commitment, with asset prices severely overvalued and a massive bubble. Many studies argue that the primary cause of the crisis was the structural problems within these economies, such as persistent current account deficits, weak financial regulation, and excessive short-term external debt, while international speculators merely accelerated and amplified these pre-existing vulnerabilities. Thus began a textbook perfect short-selling operation. This classic short-selling script can be roughly divided into several steps. Step 1. Borrowing. Soros and his associates began borrowing large amounts of what they believed to be overvalued Thai baht on the international market. This step was relatively easy at the time, as Thailand's capital account was open. The second step, a sell-off. They frantically sold off the massive amounts of borrowed Thai baht on the market, converting them into US dollars. This action directly challenged the Bank of Thailand's commitment to maintain a fixed exchange rate. Step 3. Amplify the panic. Soros used his global influence to continuously broadcast bad news about the Thai economy to the market, such as its staggering $90 billion in foreign debt, its fragile banking system, and its excessively inflated real estate bubble. This manipulation shook the confidence of all market participants, from international investors to Thai citizens who began to sell Thai baht and rush to buy US dollars, creating a so-called herd effect. Step 4. Depletion. Faced with the depreciation pressure on the Thai baht, the Bank of Thailand had only one option: to use its precious foreign exchange reserves to buy back baht in the market and prop up the exchange rate. This was a hopeless war of attrition. Speculators used borrowed baht as ammunition, while the Bank of Thailand consumed its own country's real gold and US dollars. Yuan, the foreign exchange reserves and forward contracts used by the Bank of Thailand, almost completely depleted its net usable foreign exchange reserves. Step 5. Harvesting. On the 2nd of July 1997, the Thai government, running out of funds, was forced to announce that it would abandon the fixed exchange rate system it had maintained for over a decade and adopt a floating exchange rate. Upon the announcement, the Thai baht's exchange rate against the US dollar plummeted by more than 20%. Only then did Soros and his cronies leisurely use their US dollars to buy back the baht at extremely low prices, repaying the banks that had lent them the money. This borrowing and repayment, with its huge exchange rate difference, became their enormous profits. This was a precise strike launched by exploiting loopholes in the system, market psychology, and capital advantages. Section 3. The climax and fallout. The 2nd of July 1997 will be a day etched in history. Thailand's decision to abandon its currency defenses officially ignited the crisis. But this was only the beginning. The storm's power far exceeded everyone's expectations. Like a highly contagious virus, it spread rapidly along the path of capital flows. The dominoes began to fall. After the Thai baht collapsed, international capital immediately began scrutinizing other Asian countries, discovering they shared almost identical weaknesses, the same fixed exchange rate commitments, the same high levels of short-term foreign debt, and the same asset bubbles. The Philippine peso, the Malaysian ringgit, the Indonesian rupiah, these currencies became targets one after another, collapsing in succession. The crisis spread from Southeast Asia to Northeast Asia, with South Korea also experiencing a financial storm at the end of 1997. The won depreciated sharply, forcing the government to seek help from the International Monetary Fund, IMF. This crisis even exacerbated Japan's existing financial problems, leading to the bankruptcy of several banks and securities companies in the late 1990s. Many people may ask, why would currency devaluation have such a devastating impact on a country's real economy? Here, we must mention the second core economic concept, balance sheet mismatch. Before the crisis, due to high domestic interest rates, low US dollar interest rates, and promises of exchange rate stability, many Asian companies and banks chose to borrow in US dollars at lower costs to develop their domestic businesses. This meant that, on their balance sheets, debt was denominated in US dollars, while assets, such as factories and real estate, were denominated in their local currencies. When a currency depreciates sharply overnight, disaster strikes. For example, a South Korean company borrowed $1 million in foreign debt. At the time, the exchange rate was 800 won to $1 US, so its debt was 800 million won. However, after the crisis, the won depreciated to 1,600 won to $1 US. Its assets remained unchanged, but its debt doubled to 1.6 billion won. This instantaneous bankruptcy on the balance sheet led to the collapse of countless businesses, a surge in bank bad debts, and a massive wave of unemployment. The financial crisis ultimately evolved into a profound economic and social crisis. Section 4. After the storm and revelation, resolution, and lesson. In the wake of the crisis, devastation was left behind. While the phrase, a decade's economic regression, is a rhetorical device, it vividly illustrates the severity of the crisis with many countries' economies regressing to levels seen years prior. It is estimated that trillions of dollars in wealth vanished in this crisis. The International Monetary Fund, IMF, intervened to provide assistance, but its conditions, including fiscal austerity, higher interest rates, and increased market liberalization, challenged itself due to a lack of consideration for the specific circumstances of each country and was seen as exacerbating the suffering of some nations. In this storm, the Chinese government's commitment to maintaining the value of the renminbi acted as a pillar of strength, playing a crucial role in stabilizing the regional financial situation and earning the respect of the international community. Of course, China was not unscathed either, facing export pressures and a slowdown in economic growth due to shrinking external demand. Meanwhile, Hong Kong, with the support of the central government, waged a thrilling financial battle against international speculators, ultimately successfully defending its linked exchange rate system. So, what has this perfect storm, which has been written into history, left for us today? First, the speed of growth cannot substitute for the quality of growth. Prosperity built on high investment, high foreign debt, and asset bubbles is fragile in foundation. Secondly, financial opening must be commensurate with regulatory capacity. Opening the capital account prematurely and too quickly before establishing a robust financial firewall is tantamount to inviting trouble. Secondly, foreign exchange reserves are crucial. Sufficient foreign exchange reserves are the ballast stone for resisting external shocks and maintaining financial stability. Finally, and the most fundamentally, never try to defy economic laws. Whether it's the impossible trinity or the matching principle of the balance sheet, these are ironclad rules of modern economic operation. You can ignore them temporarily, but you will inevitably pay a heavy price for it in the end. History doesn't simply repeat itself, but it often rhymes. The storm of more than 2 decades ago may be long gone, but the lessons it revealed about globalization, capital, and risk remain resounding in today's increasingly interconnected and uncertain world. If you want to learn more about the financial history that has changed the world, or if you want to learn how to understand the underlying logic of economic operations in a complex world, don't forget to subscribe to my channel. Thank you for watching. See you next time.